All right, ladies and gentlemen, September is upon us. Crypto Twitter is starting to freak out at this pullback. And I am here to answer the main question on many people's minds right now, which is the September effect here to kill the crypto bull market? Well, if you go onto crypto Twitter as of today, you'll see many people calling for the top, calling for extended weakness, saying that World Liberty Financial is going to kill the bull market, right? All of these sort of emotional based posts of people trying to justify some sort of reasoning behind why Bitcoin is not trading at all-time highs right now and is only trading at 108,000. Meanwhile, Ethereum is trading very nicely in the background right alongside it, among a couple of other altcoins that I have my eyes on. But the feed seems so concerned about Bitcoin not moving to new all-time highs and being rejected from that 125K level. So just to put some context into place before we dive into the video and sort of what people are talking about right now online, historically, and we talked about this actually in another video that I did at the beginning of the summer, talking about what you guys should be prepared for. You should be prepared for two scenarios. In this case, we've gone through the summer now. It was a bullish summer, but I said, hey, based off of the seasonals, you probably want to be careful for a 50-50 July and a pretty good chance of a red August if the market tips in the bearish direction. Now, it didn't. But for the month of September, just to give you some further context based off of the same concept of seasonality, you should be aware that September historically is Bitcoin's worst performing month and is the most common month for us to see Bitcoin prices trading in the red from month beginning to month end. Now, this is something that also carries over to the stock market, right? This is not just something specific with Bitcoin. Of course, Bitcoin is correlated with other markets. Bitcoin is correlated to traditional markets. The September effect itself is what we see in traditional markets too. Now, this is the most widely referred to term when discussing what happens to markets in September. And really what it's describing is the historical tendency for markets, specifically the large index funds in the US, to underperform during the month of September. You may have heard of the saying, sell in May and walk away, and, avoiding the period of the market between May and sort of end of September and only investing from October until early May. Now, in this case, we usually see the markets break down in September, traditional markets, crypto markets, but specifically with what we're seeing right now, it's September 1st, right? So we're on the verge of the month. We don't necessarily know where we're going to be come end of September, but usually what we do see is the S&P 500 losing around 1 to 1.2% in the month of September on average, if you go through the data and you average it all out, which does make it the weakest month historically from a performance perspective. Now, if you combine this with a secondary topic that's a little bit lesser known, but also should be discussed, and I think has some degree of prominence within this topic specifically, it is the concept of the ghost month. Okay, this is another one that we talk about in financial circles, but has a very different origin to the September effect, which is a much more North American label to why we see underperformance in the month of September. Now, ghost month itself comes from traditional Chinese culture and the lunar calendar, actually. And it's the 7th month of the lunar year, okay? And now, according to folklore and sort of ancient Chinese culture, this is where the gates of the underworld, they say, open, and dark spirits start to roam the earth. Now, we usually see this happen in a period that happens sort of encompassing about half of August and half of September. Sometimes it's more of August, sometimes it's more of September. The dates shift every single year. But when you have this, there is some degree of superstition around investing significant sums of money, making new business transactions, signing contracts. And the reason why this is significant when it comes to financial markets and why it comes to Bitcoin specifically is there is a fair degree of wealth in Asia. Right? It is one of the global wealth hubs of the world. And specifically when it comes to crypto, there is a lot of crypto investors in Asia. Now, the thing about Ghost Month is that it overlaps September for this year, right? It runs from August 23rd to September 21st. Now, what's interesting is the majority of the weakness that we've seen so far really started to occur I guess you could say about mid-August until right now, mid to late August. Even more specifically, August 23rd, right, is when we started to pull back right after the August 22nd pump up from Jackson Hole. Now, according to this concept, the peak event, which is the Hungry Ghost Festival, occurs on the 15th lunar day. Now, this is September 6th, 2025. Now, I'm not saying this is the point that marks the bottom by any means. I just want to show you that there's these two very prominent concepts that people discuss, and they're both showing towards the fact that seasonality does have an effect on markets. Now, we can look at all the previous years from 2017 forward, I think is most relevant, and see that we've had overlaps in almost all of them, right? Sometimes it only happens in August, but most of the time we do see some degree of overlap in September. And what's interesting is if we just look at 2024 specifically, you can see that the lows were put in early September, Friday, September 6th, right after this period ended. And if you go to 2023, for example, Monday, September 11th, right, 2023, right here, just before the period ended as well. So very interesting to see this. Now, this year we're not ending this sort of ghost month period until mid to late September, around September 21st. But it's interesting to see that most of the time we do see the ghost month also overlap with September usual weakness. And the two weakest months of the year that we see for Bitcoin, that we see for equity markets usually are August and September, where we see these sort of pronounced, more scary declines on thinner summer volume. So here's a couple examples of this exact concept. If we look at last September, we saw a weak August with a rebound towards the end of the month and then a pretty sharp drop into the lows of early September. We marked the bottom for the rest of the year before resuming the uptrend early in September on September 6th. The year before, in 2023, we marked the bottom on September 11th, right? We broke down in August and we marked the bottom in early September around the 11th. Now, if we go back to 2022, I see this year as being a lot less relevant in comparison to this year because it was in the middle of a bear market, but we marked the lows in late September around the 21st after, of course, also seeing strength in early August and then a breakdown in mid to late August and so on and so forth. So very interesting to see these parallels where almost every year in the summer we're getting this pullback during August that leads into September. Bear market, a bit of an anomaly year. That's why I didn't put a blue triangle beside it. The ones with the blue triangle are the ones I think are the most relevant. Now, if we go to September 2021, which is the most comparable to the current market environment that we're in terms of the nature of four-year cycles, if you want to study that, September of 2021 told us that the low happened on September 21st, right? We had a relatively bearish month the entire time. We started to break down first week of September and continued moving lower all the way till the end of the month, where we broke out in October to go towards our final round of all-time highs. Now, when it comes to 2020, we had a breakdown late August. We put in the lows early September, and then we traded sideways and started to rebound higher. So the common theme that you'll see is that there's a lack of upward momentum in the markets in the month of September, right? But if you were a buyer in any of these scenarios, even in the bear market, you were getting excellent buys relative to where price was 6 months later, okay? So that's the key thing to be noting here, is that these are opportunity zones for you to look at the market when there's panic and go, maybe there's opportunity for me to accumulate. Let's go back to 2019. So in this case, in 2019, bit of a weird year from a price action perspective, but we saw the weakness in August, further weakness in September, and then more weakness going towards the end of the year. But if you go 6 months past this point, what you would see is that prices were trading up towards much higher levels than where they were in September. Then if we go to 2018, right? Similar kind of concept before we had this breakdown that kind of marked the bottom of this 2019 bear market. We had weakness in August into September, traded flat, no momentum, and then we broke down at the end of the year. Again, bear market year, right? This is 2018, sorry. 2018 bear market year looked very weird, right? 2018 and 2022 look similar, right? Breakdown in November to mark the lows, right? breakdown in late November to mark the lows of the bear market. Then we go to 2017, which was a bull market year, again, most comparable to 2021 and 2025, where we are right now, is we saw a pullback, right? From August all the way down to the lows of September on September 15th. And then we had basically a month of nil performance, and then October kicked into gear and we started to resume the bull market up towards our final push to all-time highs at the end of Q4. Okay, so this is the reality of the situation over the past couple of years. We've seen weakness in September, but each and every one of these periods of time has been a buying opportunity. Now, I've excluded the years that were technical bear markets, right? Bear market years, as not being the absolute best buying opportunities, but over the long term, they were still excellent buying opportunities. Now, given the fact that we're in a bull market, I think we're most comparable to 2017, to 2021, even 2020, and then sort of where we are. I would even say 2024 is comparable to this as well, given the fact that we had a very strong Q4. So some of these years are starting to look very similar, even though they're different years, technically speaking, within the cycle, right? So here's what crypto Twitter is saying. Here's the historicals. Here's where this comes from. Here's what it looks like. Let's talk about this fall, this September. What does September of 2025 look like for the markets? Well, everything is based off of the macro picture, right? And if I'm the first person in markets to teach you this, that's a fantastic concept to understand, but that's the truth. Markets don't move off of hype. They don't move off of sentiment. They don't move off of magical indicators. They don't move off of what people tell you on Twitter with NFTs as their profile pictures and weird names. They don't move off of any of those things. They move off of the macro backdrop, okay? When macro conditions are weak or pointing towards weakness, markets break down. They price that in. When macro conditions improve or when they're running hot, markets price in upside, right? And if you look at the current macro picture in terms of what we're seeing in early September of 2025 is a rebound in economic activity, right? We're not in a recession. We have inflation that is rising, but relatively slowly. It's not a massive jump up in inflation. And we have one of the key pieces of the puzzle, not the most key, but of course, one of the more important keys, is that the Fed is sending dovish signals about lowering rates amongst all of this uncertainty that we've had around when are we going to get rate cuts. So the first thing I want to go over is a slide from a BNB call I did recently talking about Jackson Hole. And so Jerome Powell did speak basically the last week of August, and for the first time this entire year, since he stopped deciding to cut rates back at the December FOMC meeting, he signaled the potential for a September rate cut. Now, he stated, the stability of the unemployment rate and other labor market measures allows us to proceed carefully. Nonetheless, with policy in restrictive territory, the baseline outlook and shifting a balance of risks may warrant adjusting our policy stance, which is a fancy way of saying there's a good potential that we could start to cut rates here and change monetary policy to be more dovish. So this is the first key that the market's seen, or the first clue, I should say, that the market's seen that monetary policy actually has the ability or high likelihood of changing in the coming weeks and over the course of the coming months. Now, some people may argue that rate cuts are bullish, and some people may argue that rate cuts are bearish, and I'm going to dedicate another video this week to talking about those two concepts and comparing and contrasting them both so you understand exactly what could happen in both scenarios. But the reality is that if we were to see rate cuts later this month at the next FOMC meeting, those cuts would be into economic strength, not into economic weakness. You can see that there was revised GDP data, and I discussed this in BNB, of course, with members, where we saw the revised data showing an annual growth rate at 3.3% in GDP, right? This is above the initial 3% estimate and above the 3.1% forecast that we saw. We also saw final sales to private domestic purchasers was revised up to 1.9% from 1.2%. So that's a big, almost a double increase in the revision. And then we also saw pretty good consumer spending. I don't have the data built into this particular slide here. I discussed it more in depth in BNB, but we saw an uptick in consumer spending. We saw an uptick in wage growth. And these are signs of economic strength, not signs of economic weakness, right? So one thing I discussed with everybody in BNB just before we got into this month was, while September has historically been the weakest month of the year, strong fundamentals from a macro and, from a Main Street perspective could potentially drive us to performing well by the end of the month when you mix in this potential bullish catalyst. It's not a guaranteed bullish catalyst, but a potential bullish catalyst of a Fed rate cut into economic strength. This is not a cut into weakness. This is a cut into strength as of right now, right? And even if the labor market data is incredibly weak when we see it at the end of this week, it doesn't mean that they're cutting into weakness, right? If you look at GDP, it's getting better. If you look at consumer spending, it's getting better, right? The economy is strong. All of the leading indicators are moving higher in the markets, right? We're not seeing the soft and the hard data move down dramatically. We're pointing towards economic strength. It's not pointing towards recessionary themes or tones, right? We saw the revisions to GDP. We saw a first half growth rate of 1.4%. That's not in line with the recession. Even though the markets were in panic and in turmoil earlier in the year about potential recession, and everyone basically flipping the switch to saying, hey, we're in recession mode now. First half of 2025 showed annualized growth rate of 1.4%, right? Stronger than expected investment in consumer spending. Doesn't show economic weakness. Then we can look at the PMIs, right? The ISM Manufacturing Index survey was 48 in July. It bumped up, the PMI manufacturing one rose up to 53.3 in August. So this tells us that there's a return to expansion in business activity when it comes to manufacturing, right? We did see a bit of a July contraction, 48. Then we moved up to 53.3 in August, above 50, okay? Now, that July number was the lowest that we'd seen since December, so that was a little bit concerning. But when we see the bounce back and the improvement, it shows that it's just more of a one-off piece of data than it is an actual structural trend or structural change in trend, I should say. Then we have Jackson Hole, which we just talked about, right? They're saying downside risks to the labor market have increased in recent months. That means, hey, we're a little bit more worried about the labor market than we are worried about inflation. They've been trying to tackle inflation this whole time with higher policy rates and haven't been able to do it, right? So they haven't committed to cutting, right? But his comments made it much more open to the fact that, the balance of risk may warrant adjusting our policy stance, right? Those are probably the most famous words of the past couple of weeks in terms of what could shape markets for the rest of the year and into early next year, is the fact that they're looking at potentially moving their policy stance based off of worrying about the labor market more than inflation. Now, what happened is we saw expectations for rate cuts jump up dramatically after Jackson Hole. Even before Jackson Hole, we saw almost a near 100% chance, which was a little bit out of whack. Now we see it at 89%. It was as low as about 75% recently. But this is a strong number. I just updated it before recording today on September 1st. 90% chance of easing at the next Fed meeting, the next FOMC meeting that we see in late September. So what else do we have on our side for a potential rebound in markets either in September or once September's over? Well, we have very strong Treasury policy at the moment, fiscal policy, right? We're seeing the Treasury announced $1 trillion of new borrowing for the July to September quarter. This is a very big increase. And all of this, for the most part, has been funded by T-bills. That's what they've been focusing on, is funding the government, taking care of the debt with short duration issuance, right? I've talked about this. Go and look at the podcast that I did with Leo here talking about the significance of this. I've mentioned it a few times in these videos, but short-term debt duration, or short duration debt issuance, I should say, is important, right? It is liquidity positive for markets. And we've seen the Treasury relying on T-bills as this big buffer for sort of seasonal or unforeseen borrowing requirements. And this is liquidity positive for the markets, right? We can see that the Treasury stance for the time being is one where they want to be in control of what's going on when it comes to debt management. They're focusing on liquidity. They're focusing on auction stability. They're focusing on short-term issuance. All of these things combined, especially when you see the Fed getting a bit more dovish than they have been recently, considering rate cuts and all of that, it shows that both of these entities are wary of letting any sort of expanding deficits or tariffs or anything like that destabilize markets or crowd out growth. They want to support the economy for growth, and they want to support the asset markets and allow for growth there. They're not going to say this. They can't blatantly come out and say this, but their actions speak louder, right? Their actions speak louder than their words, and really their words don't matter nearly as much as their actions. Show me what they're doing, and I'll tell you where the market is going, right? So this is all very positive stuff. Now, again, what does this really materialize into, right? Where's the actual impact that shows that financial markets have an opportunity at continuing to new all-time highs and beyond? Well, let's look at global liquidity, right? Let's look at financial conditions. You can see here, this is the global liquidity index in orange or yellow, however it looks on your screen, in the middle of this particular chart. And you can see it's at new highs of about 184 to 185 trillion, depending on where you pin it on the day. And then below that is the MOVE index, bond volatility index. So when financial conditions are tight, this spikes, right? This MOVE index spikes up when financial conditions are tight or tightening. In this case, it's been going down for months and months and months, showing a loosening of financial conditions. You can look at the National Financial Conditions Index. It's also at levels that we haven't seen since we were in a bear market and financial conditions were increasing back in 2022, or when financial conditions were tightening in 2022. Now, this is not my chart. This belongs to Thomas on Markets on Twitter, but it's a great chart nonetheless, describing the relationship between financial conditions and what's going on in the economy, right? So we have global liquidity ticking higher. We have global M2, which has been ticking higher. Even though Bitcoin has been paused in its rally, global M2 has been moving higher. So there's more money in the system. Global liquidity is moving up as a result. It's also moving up because the US dollar has been weakening dramatically, right? We're not seeing any rebound as of right now in the US dollar. And we'll talk about that in a chart that I'll do when I update you guys on later in the week, when I update you with some charts that I want to show you now that we're going to make these market updates a little bit more frequent. I do have the time. I'm back almost in my home office, new home office. So I'll be updating a lot more for you guys, but we're seeing financial conditions loosening, right? We're seeing global liquidity moving higher, global M2 moving higher, right? All of these things are not indicative of an immediate bear market surfacing for markets, an immediate slowdown in markets across the board that's going to be sustained, that's going to be multi-month or multi-year by any chance, right? We also have, looking at the Chicago Fed National Financial Conditions Index, we haven't seen conditions this low since end of 2021, early 2022, right? So there's many things going on here. Again, look at what's going on with capital flows moving into Ethereum at a record rate. Fifth most inflows in August out of every ETF in the United States. I don't know who called that one, but all I have to say is that it was very obvious now in hindsight that this was going to happen. But in the moment, almost very obvious as well that this was going to be a big trade of the summer as soon as institutions decided to get on the wave of positioning for the stablecoin narrative. So again, if you missed Ethereum, you missed the 100% run up in Ethereum, you obviously missed this video, because I posted this video still when Ethereum was 2,500. So I essentially gave you guys publicly the same entry that I gave all BNB members at the time, except in BNB, we were preparing for this moment for months ahead and getting organized and getting, educated on the fact that this kind of rally was likely to be experienced out of Ethereum, because it had just been legitimized by things like the Genius Act and upgrades like Pectra, so on and so forth. So we were prepared for this. I put this one on YouTube. It was a sleeper. Some of you guys caught it. A lot of you guys didn't. If you weren't in BNB, you didn't catch this. Most of crypto did not catch Ethereum's comeback, and they're sitting here FOMOing in now at 4,400 and wondering if we're going to get to 10K. I'm not going to come out here and post my price targets on Ethereum publicly. I don't operate based off of price targets, even though I could sort of point towards where price likely has the opportunity to go. But what we're seeing here, going back to the topic of what September going to look like, is financial conditions are loose, global M2 is on the rise, global liquidity is on the rise. US dollar is still not making any meaningful rebound. It's trading around the range lows. It's trading sideways, right? So everything looks good from this perspective. Now, I'm not here to say that there's no risks, that there's no hiccups that we could be running into. One of those things that we're experiencing right now in markets is the refill of the TGA, and this does naturally suck liquidity out of markets as it's attracting money into the government's bank account that's otherwise going to sit in the financial system. So this isn't the most liquidity positive event, but this isn't happening in tandem with a bunch of other things that are contracting liquidity from markets. It's sort of a one-off. Then we also have people arguing, well, Bitcoin whales are selling, right? Bitcoin whales are selling. Therefore, those are the smartest market participants. If they're getting out, then we must be getting out of Bitcoin as well. And I thought this was a really good point by this analyst on Twitter saying people who bought Bitcoin in 2010 to 2014 understood the asymmetry but are not fortune tellers. Reading old whale sales as if they know something is misguided. And the opposite, the healthiest thing is for old whales to sell and distribute. I love when the countries and old whales sell. If you don't get what I'm saying, read this from an old whale. Bitcoiners today have a much better grasp. So this person was not super financially literate at the time, literate enough to understand that Bitcoin was an opportunity to take advantage of, but not in the sense that, hey, this is going to replace the global financial system and, all of the world's capital is going to be buying this at some point. He said, I've got about 50 grand. It's not going to end my life if I lose all this money, but this is my life savings for now. I'm going to put it in Bitcoin. And my main argument is that there's only 21 million Bitcoin, right? I don't want to put it in a house. I don't want to put it in a wedding because I don't see any upside in that. I do see some degree of asymmetry with Bitcoin. These are people who are now incredibly wealthy, right? Incredibly wealthy. They were buying hundreds, thousands of Bitcoin back at this point, hundreds of thousands of Bitcoin at this point, way, way back when. Whales. Not all of them are the world's smartest investors, right? It takes time for people to really understand the true value of Bitcoin to the degree of which it's sort of understood nowadays by many of the high-level, high-league investors in this space. So whales selling is not the most bearish thing in the world. What is bearish and what can mark the end of market cycles is when financial conditions tighten, when global liquidity trends down, when global M2 trends down, when policy changes pivot to the hawkish side of the equation, not the dovish side. Remember, we're about to experience rate cuts most likely. So I'm just telling everyone to zoom out and look at the macro picture before you start calling the top of this market cycle potentially prematurely, right? It could be in. But the likelihood based off of the macro data, which I do believe as being the most important data to look at, is not telling us that the top in the market cycle is in for crypto, for equities, etc. So that is my conclusion on where I see things going for the month of September. If I had to make a prediction, I would say this will be one of two scenarios this month. We'll put in the lows relatively early if we haven't put them in already today, and we'll rebound and have a very strong month that throws a lot of people offside, or we're going to have a slow bleed for the entirety of the month that's going to cause people to throw in the towel before we have a pretty compelling rally when Q4 starts. Now, everything's subject to change in the meantime, and obviously everyone inside of BNB is going to know my thoughts on the market every single day as I update them first, but I will paint the broader picture here for you guys on YouTube while I'm doing these videos in hopes that at some point very soon you decide to work with us in BNB where the real alpha happens, where the real alpha is and where the magic happens when it comes to markets and our positioning, because that is where we do it best. If you're looking for more, please do subscribe to this YouTube channel where I'll be updating you guys with about 3 videos per week going forward to the best of my abilities. I post daily on Instagram. Number of videos here for you guys to catch up if you're newer to the channel. lots of stuff here. I would watch this video that Leo and I did that gives you a great overview of the macro picture. This video I did on Ethereum, predicting the comeback. I did a very long webinar here, live masterclass, talking about the summer heat wave rally that I saw coming. It played out perfectly to a T, right? I've been very on the ball recently with crypto, and that's because you just have to be in tune with the right data, right? I'm here on YouTube discussing topics in the crypto industry that nobody else related to crypto talks about. They don't know macro. They don't understand macro. And macro is everything, as I can assure you from reading these markets for 6, going on almost 7 years now when it comes to looking at these markets full time. So if you want my day-to-day insights, you want weekly live calls. And just to give you a taste of what that's like, I just did recently post a snippet of 4 hour-long calls. We condense it into an hour and 40 minutes, the best parts, the most relevant parts, I should say, of my analysis. If you want to get a preview of what the caliber of research is like inside of BNB and the ease of delivery in terms of you being able to understand complex topics, I recommend watching this video that we compiled and put together and just posted a couple days ago for you guys. And if you do have $50,000 or more and you are considering yourself as a serious investor when it comes to crypto, or maybe you're not a serious investor, but you have too much money in this market to not have a plan for and a proper structure, then I highly encourage you to join us inside of Bull Market Blueprint, which is my private investing mastermind for all things cryptocurrency investing when it comes to crypto-related equities, and just overall how to be a smart, sovereign global investor and maximize the opportunities that we have with us. We are all 5-star reviews on Trustpilot. You can go and see them. They're all verified. They're all written by real people. You can go and find these people on Instagram. You can message them. You can talk to them about their experience. I mean, they've given you their thoughts here, so I don't see why you need to do that. But if you are one of those people who is paranoid about other people who offer products or services on the internet and call everything a scam, all of the data is here to tell you that that is not the case with Bull Market Blueprint. You can go and check out our website. You can click on our Trustpilot here. You can see these reviews. You can read them for yourself. I highly encourage you, if you are not in this group and you are investing with $50,000 or more, you should read these reviews. You should go through our website. You should watch this video, because it does not make sense for you to not be in Bull Market Blueprint, especially as we get into these later stages of the market cycle where things do get more volatile, where the market does get more explosive, and everything gets much more tricky to manage. If you didn't rotate a good portion of your portfolio or condense all of your altcoin exposure into Ethereum over the past 60, let's say 90 days at this point, then you didn't play the market cycle well for this summer period. If you've sort of been trading sideways and getting chopped up in altcoins, you've not been doing things properly, right? We've been doing things properly. Bull Market Blueprint is the place to come in and master this market cycle within. You can see we've got many testimonials on the website, videos. I've got all of our proof here posted in other YouTube videos. You should probably watch this one, right? Many altcoin investors losing money this entire bull market because they don't understand one simple concept of it must be outperforming Bitcoin to even hold it. And if Ethereum is outperforming Bitcoin, then it must be outperforming Ethereum to hold it. We jumped into Coinbase way early before it was listed in the S&P 500. We're on the ball, guys. BNB is the place to be. And today is September 1st. Today is Labor Day. So if you've made it all the way to the end of the video, I do have a nice nugget for you, which is the fact that we are running a Labor Day sale for the next few days. You can send me a DM on Instagram, or you can apply through here and just mention that you saw the Labor Day sale on YouTube, and you will get a decent sized discount off your membership and a couple of added bonuses. But yeah, it's Labor Day. It's September 1st. We're at the beginning of a new month, coming to the beginning of a new quarter very soon as well. It could be the last quarter of the bull market, may not be. Regardless of what happens, you're going to be the most prepared alongside myself and my team of analysts inside of Bull Market Blueprint. If you're interested in joining us in the group and you have $50,000 or more in your portfolio, this is the QR code to scan with your phone. Submit your application. Go check out our website, bullmarketblueprint.com. And if you're a serious league investor, 100K, 250K, 500K, $1 million plus, you cannot afford to not be in this group when it comes to not having the right access to information for your crypto portfolio. There's too much money on the line here. There's too many mistakes to be made. I help people avoid making massive mistakes with their portfolios because I give them the right access to information and I give them the confidence they need to make the right decisions with their own money. With that being said, that's it for my market update for today, guys. Happy Labor Day. Labor Day sale is on for BNB, and I'll catch you guys in the next market update. Cheers.